Hello there, and welcome to another edition of the Premier Investments and Wealth Management Financial Program. My name is Doug Wagner, your host. Before I introduce the gentleman around the table with me, I want to take a second to remind you to grab your phone, your tablet, maybe sit down at your laptop or just put it on your lap because that's what it's for. Don't put the desk on your lap, though. That doesn't work too well. Open your desktop and go to your favorite browser. Click on premieriwm.com. Odds are, if you're watching this show, you've been there before, but I want to say premieriwm.com. Then click on Get Started, answer a few questions. They will provide you with a one-page Premier Vision document. And it's really that simple for you to find out, are you ready for retirement? Are you ready for maybe the future of your kids' education? Whatever you're trying to invest for, not just save for, but invest for, they'll be able to help you with that Premier Investments one-page Premier Vision document, premieriwm.com. They'll even schedule an appointment with you so you can sit down with one of the folks who are around here. You can schedule an appointment online at premieriwm.com or call 800-383-6590. Again, Premier Investments and Wealth Management, named to Forbes 2025 Best in State Wealth Management Teams. Introducing from your right to left, from my right to righter, he is
just further to the right.
Exactly. He's a wealth advisor, accredited investment fiduciary, a certified financial planner professional with over 10 years of experience in the investment industry. He is Dr. Casey Mushrush.
Good to see you, Doug.
Hey, how you doing?
I'm doing good, neighbor.
Good summer for you so far?
Oh, so far, kids are busy. Yep.
That's the most important
thing. I don't know if you've been watching us trolling our way down to the pool every about 4 times a week, actually, at this point. So.
Oh, it's a perfect time to do that. Also, to his right, a wealth advisor with over 30 years of experience in the investment industry, Jonas Everett. Good to see you, Jonas.
Good to see you, Doug.
How are you?
Great.
Got the sunglasses just in case it gets so bright in here today.
Yep.
It's awesome.
The future's so bright, I got to wear shades, Doug.
You just put yourself right in that box of that person who's old enough to know that reference.
Apparently, I'm not in that box.
I know you're not in that box. That last voice that you heard, he's a president and wealth advisor, accredited investment fiduciary as well. Over 22 years in the investment industry. That's how much experience he has. He is the big kahuna, Roger Abel. Good to see you again.
Good to see you, Doug.
How are the fish biting, buddy?
They're pretty good, but the boat's riding better.
Ooh, okay.
More boat rides than fishing right now.
Okay.
A couple weeks left, and that season will kind of be over, unfortunately. Went really fast. It's hard to believe it's halfway through summer already.
Man.
I mean, it's July something. I've lost track of the days, but
I know.
It's July something. I know we're halfway through.
One. We start thinking about how quickly everything goes, and it's for us. We remember just the very, very beginning of the year. Everybody was terrified about what the market was going to do, and then we started talking about Independence Day, the idea
Liberation
of Trump's
Day.
tariffs. Yeah, exactly.
Day.
Yeah, and we started talking about that, and the idea that we've been moving, and it's been such a fluid situation. Here we are back now, and they keep on going. Where is it? Is it going to be a record high? Or are we going to be paring back? But the idea that you invest, buy low and sell high, that makes sense. But when we're already at record highs in a lot of cases for these markets, I need you to sort of reset everything for me, because it's like a new paradigm. Because every day it seemed like, for a while there, every day was another new high, Roger.
There's a new high every 19 days on average.
Mm-hmm.
Most people don't get that. Obviously, buy low, sells high.
Mm-hmm.
If prices were to stay in a range, but if you really think about it, what do asset prices do, or how have they trended over time? 100% a fact, they have trended higher. Over time.
Mm-hmm.
So the idea that you would buy low and sell high, it's actually not that grand of wisdom.
Mm-hmm.
I mean, if you're looking at something that ranges between $10 and $20, yeah, sure. Well, we should sell at 20, buy at 10. That's not what stock prices do. Indices do. They trend higher. So you have to almost reframe how you're thinking when someone says, is it too high to buy? And we have some data here. Since 1957, the S&P 500 has closed at a new all-time high 1,200 times. So it averages a new high every 19 days. And we're going to talk later in the show about the numbers behind it, but buying low and selling high is not the way to win. That's a trader mentality. It's not an investor mentality. You might get lucky. But here's what's really, I think, very interesting about the human psyche. There's two components of the stock market, right? There's prices and volatility.
Right.
Those are the two things that really run it. And volatility always reverts to the mean. So if you have a mean number, volatility always reverts. But as humans, how do we react to volatility? When it hits an all-time high, we're like, oh my gosh, it's going to be here forever, even though we know volatility reverts to the mean, but we run our emotion off of that volatility of, oh, it's really high, things are dangerous now. For example, the tariff.
Right.
It was Independence Day or
Liberation Day.
Liberation
Thank
Day.
you very much.
Okay, so tension's running high. Everybody thinks it's going to stay high forever. We should get out of the market. Well, but if it reverts to the mean, the prices trend higher, you should have just bought.
Yeah.
So I think that's one thing to recognize, that people are just really bad at trying to time the market. The best time to buy is when you have the money to buy.
And it's something, Jonas, as far as this goes, instead of like the buy low, sell high, it's buy and hold. I mean, really, because that's the way to get what you're talking about as far as selling high. If you're looking at a new market high every 19 days, just hold it for the long term.
Well, I look at the buy low, sell high concept, and I think it really hit me. I was getting ready for the radio show on the kitchen table one time, and maybe it was the computer room, and dinner was ready, and my wife Jody came in and said, "What the heck are you doing?" And I had all these papers spread out. And I'm like, I'm getting ready for the radio show. And she's like, well, just tell them to buy low and sell high and get in there and eat. And I think that, it's just a concept for people that aren't in the investment business to grasp, because I think about April, and I think about a phone call that I received from some retired customers, and they were panicking. I mean, they were legitimately threatening to go to cash. And I said, I want to be your calming voice here. Is this an opportunity for you to buy low?
Yeah.
And he started to chuckle. He's like, what do you mean? I want to sell my investments. What are you talking to me about buying low? And I think that it's just, it is better. I think that Roger's right. It's better to kind of reframe this. That statement, but it kind of reminds me of what Elias said one time on the radio show, that really, you don't belong. And if you think Americans are done buying stuff, you don't belong investing in the stock market.
That's a very good point, Casey. I'm going to come to you with that reminder. Go to premieriwm.com. Check out the website. Also, you can call for an appointment today. If you'd like 800-383-6590. Premier Investments in Wealth Management, named to Forbes 2025 Best in State Wealth Management Teams. Dr. Casey Mushrush, the concept that what we're talking about here is a lot of this tied to earnings, which is really sort of the next point we want to go to, because people continue to buy. And if you think that they aren't, then maybe there's another place, whether it's credit, whether it's cash, the numbers just continue to improve.
Yeah, I mean, if we look at correlations over the course of the last 50 years or so, I mean, there's a 97% correlation between earnings, company earnings, and increases in the stock market. Now, just to put this in statistical terms, that's dang near perfect.
If earnings go up, prices go up. And to your point, earnings, if people started to think about how earnings actually drive stock prices, that would make everybody better investors. And you'll probably elaborate on this, but each sector really has its earnings multiple, that price for that stock, right? Like if you look at the technology sector, there's an average earnings multiple, the same for financials in different sectors of the market.
Yep.
And if you peel back that layer again, for people not in the investment business, do you want to be an owner or do you want to be a loaner? Do you want to own those businesses that have earnings?
And earnings
or
growth.
Do you want to loan your money to the bank?
Yeah.
Or do you want to loan your money to these companies in the form of a bond? And I think that, I want to be on the ownership side. I want to be a part of these earnings.
Well, that's where the greatest returns are.
Right.
That's why historically, because there's more risk in being an owner, right? If earnings miss, prices go down.
Yep. Well, I still look back at that statistical relationship though, right? Because, like anytime we're doing any sort of an analysis as far as like these correlations, really anything over 80, we consider that highly correlated. Like when it comes over to the comparison, at least underlying various different investments. And that is very significant. Like, that 97% correlation on there is just absolutely incredible, at least in terms of that earnings compared to that long-term return.
Yeah, and you start looking at it and you start wondering about, okay, the need to make the case and sort of put this together because timing the market's really difficult. There are reasons to say, Roger, you need to invest, especially when the market is high and especially when earnings are coming in at really good clips.
Here's what's ironic. I think we'd all agree that the stock market being at an all-time high should be a positive, right? But many people look at it as a negative, like, hey, it's at an all-time high. Why would I buy now? And here's something to think about. First, all-time highs are a feature of the stock market, not a flaw. Right? People see it as a flaw. That's a feature of long-term investing. You're going to get new highs. The second thing is when the stock market hits an all-time high, it's a sign of growth. That's a good thing. And and I'll be honest, before we put this together and I looked at this chart, I probably wouldn't have thought this way. Like most people think that buying the stock market 5% lower, like that's how you win. But we've got a chart. So if you're watching this online, I'm sure we'll put it up there. But it compares going back to 1989 to today, investing at all-time highs. So meaning you only bought on an all-time high.
You picked the worst day of the market to invest in that year.
Right. Yeah. Okay. The 1 year trailing return, the worst day versus a dip day. Okay. So all-time high versus a dip. 1 year later, the person who bought an all-time high averaged 13.3%. The dip buyer averaged 11.8%. Okay. 5 years later, the all-time high buyer averaged 11.5%. The dip buyer averaged 10.4%. So when somebody says buy low and sell high, I don't believe they're a good investor because the numbers prove it doesn't actually work. Like it doesn't work. And part of it is asset prices trend, right?
Right.
Okay, so the stock market goes down 5% and you think it's a good time to buy. Well, what if it goes another 20%? You're buying on the downtrend. There's ETFs out there that buy momentum stocks only in the S&P 500. They vastly outperform the index because they are buying stocks when they're trending in the right direction. And I've talked about this with Elias before. As information moves faster, stock prices tend to move more. If you look at the last two 19% drawdowns, let's look at the last three, COVID 22 and this year, that's 19% or greater. 2 out of the 3 were over in 60 days. 60, 90 days, it was over. We're back, screaming stock market. So part of information just moving faster causes people to try to get in and out at the wrong time.
Hey, Jonas, I'm going to come to you before that. I want to make sure to remind people to go to premieriwm.com and click on Get Started. Premieriwm.com is the website for Premier Investments in Wealth Management. You click on Get Started, you'll answer a few questions, and they'll provide for you what's called a one-page Premier Vision document and an opportunity to sit down with one of the professional wealth advisors at Premier Investments in Wealth Management. From there, you can find out and answer these questions. Am I ready for retirement? Are my investments where they need to be, how they need to be for my age, my expected retirement years? Do I want to leave a legacy, or am I going to give with a warm hand rather than a cold hand? How am I going to do these things? My friends at Premier Investments in Wealth Management can help you. They've been recognized by Forbes as 2025 Best in State Wealth Management Team, and you can go to them and make that appointment online at premieriwm.com, or you can call 800-383-6590. We're talking about the market and with Casey Mushrush. with Jonas Everett and with Roger Abel. And Jonas, I want to go to you because we've been talking about, do we buy when the market's high? Well, one of the things is that people have a difficulty with, and we've fleshed this out on the radio show a million times, this idea that buying when it's low, that's coupon clipping, baby. That's a perfect time to get in there on the market. There are a lot of people who are still concerned about buying when it's so low, even, when it's gone as low as it may metaphorically go. So you got people who are scared on both ends.
We do, and it really it depends on what stage of life you're in, too. What milestone that you're looking at. I mean, maybe you're in retirement. Maybe you're in the what we call the distribution stage, where you want to start taking some money off of your investments. Right. But we talked at length, Doug, that maybe this is an old archaic concept that we need to throw out the window, the buy low and sell high. But it's fun to talk to the I'm not going to say non-investor, but somebody that isn't as interested in investing as we are.
A passive investor.
Yeah, a passive investor. And, it reminds me of what Warren Buffett said. He was asked, okay, if I'm not interested in investments, we all are at this table, what do I do? He said, well, put your money in the S&P 500. And that was his statement. That's not an endorsement, by the way. So
that'll get it out.
One of the things, and I'll kick this over to the guys. We've been on the TV a long time. This is recorded, right? This is a TV show.
So the cameras
It's a
are
podcast.
You got a camera on you.
Well, we were on the local Channel 9. We had our own show. That we had commercials and everything else. And I think we were the first investors, financial advisors, to say, quit looking at your balances.
Yeah.
If you're going to do that, then go check Zillow out and check the balance of your home. And if it's low, are you going to be bummed out about it?
Yeah.
If it's high, are you going to sell? Or you're going to start packing? Hey, honey, we got to sell. Our home price is up 20%.
It's funny because Kelley Blue Book every week sends me what my car trade-in value is worth compared to the week before.
You day trading your car now?
No, I signed up because I was curious about something that just bangs my email trying to tell me.
Okay, so here's what's really ironic. You ready for something really, really ironic?
Bring it.
An investor this year who only checked their statement quarterly, meaning they got their March 30th statement,
Right.
and then they got their end of June statement. They never saw a dip. Because the dip didn't actually happen until April 2nd. The S&P 500, which is just a broad index, not an investment, just an index that tracks prices, is up 7.9% as we film this. So the person who checked this quarterly literally saw no volatility. Went up a little bit the first quarter. Then it went down during April.
Yeah.
And now they're up 7.9. They're going, this is an unbelievable year. But if you got caught up in the media, you're listening to the news, you're watching the nightly news, doesn't matter what channel it is, you'd think all heck is breaking loose. At the end of the day, we've had two back-to-back 20% years, and we're up 7.9% halfway throughout the year. That's not actually normal.
Yeah.
If you look at most cycles, we've had two back-to-back 20% years. The third year, it's up, but slightly. I mean, if we keep this pace, it's plus 16.
Yeah.
Roger, what do you say to people that say their comeback is, I just really want to be informed. I want to be informed on what's going on in the world. And that leads me to check my 401k balance.
No, they don't want to be informed. They don't want to be
Can you
informed.
handle the truth?
They believe they're supposed to. They actually haven't figured out that the stock market doesn't care about effort. It doesn't.
Wow.
The stock market does not care how much effort you put into it. You can study charts, all this. It doesn't matter. They don't care. Like checking your 401k balance. Why would you do it? Why would you check it every day? There's nothing you can do to change it. You shouldn't change your asset allocation unless you're already misguided. You haven't, if you've done a plan and you know what your asset allocation is, frankly, there's really not a reason to check it other than you just want to know, did I make money? And that's a bad cycle because now you're in the mindset of short term. Did I make money? Did I lose money?
Well, and that even goes back to generally the way most 401ks are set up. right? Meaning, even if you're going to make a change, what are you going to do? Move to one of your other 13 funds?
Right. Everything's
There's not
prepackaged. Yeah.
there really isn't a way to actually be super tactical when you're actually looking at even the 401ks. That's why one of the things when we see the 401k day trading, like the statements on that, they're even worse than normal.
So it reminds me of lawns in Iowa real quick. This is where my brain's going. You know, the some lawns stick out like a sore thumb in April and June because they haven't been mowed. 99% of the lawns, all the lawns look the same. And then August rolls around and guess what? Everybody's crispy.
Yeah.
So the August lawns in Iowa are just what happened in April in the stock market.
So
Everything went down 18%.
So I just have to wait another couple of months and my lawn will just look like everybody else's then?
Yeah, it'll all come back, dude.
Yeah. If you have a portfolio that sticks out like a sore thumb, you need to get in here and get it reviewed.
So if you just reviewed your lawn after the first mow in April, stuff's great. Doesn't matter how bad it is the rest of the year.
I tell you, I'm going to hit on something real quick, and then we'll take your break here, but then come back to you guys because it's important to recognize that what you just said there was really remarkable because it's this whole emotional reaction and the psychology of investing that's something you all talk about at Premier Investments and Wealth Management, what you do in order to minimize the psychology of investing because you can be emotional about it, and that is a problem. You do not want an exciting portfolio, okay? I do not want an exciting visit to my car repair shop, okay? I don't want an exciting house painting event. I just want it to be routine, normal. And part of that is making sure that it hits the middle. Everything comes back to the middle. We're going to talk about dollar cost averaging when we come back here in a second. It may seem really boring, but it's important because it's part of what they say at Premier Investments and Wealth Management. You know what? You can invest in what you're investing in, and it's a long-term investment. You're not going to be chasing that needle. You've got a haystack. That is part of the market. Premier Investments in Wealth Management at premieriwm.com. I want you to go there, click on Get Started, answer a few questions. They'll provide for you a one-page Premier Vision document that'll help you understand if you're ready for your financial future, whether it be retirement or leaving money off to your children or maybe purchasing that lake home, that hunting cabin out in the woods in the West Texas hills, or you're down pheasant or deer hunting in southern Iowa. Either way, you can work with them at Premier Investments and Wealth Management. Call to make your appointment as well, 800-383-6590. But when you go through that Get Started, they'll schedule you an appointment with one of the wealth advisor professionals at Premier Investments and Wealth Management. We talked about the lows of the lows and the highs of the highs. We talked about not only the emotional, but the market of everything that comes in the middle, though. You want to hit the average. That's the whole point, because the average 99 times out of 100 keeps going up, right?
You talking about dollar cost
Yeah,
averaging?
it's critical to do that because you're investing. It's passive investing. It's very non-emotional investing.
Well, I think that when you look at the dollar cost averaging strategy, it's exactly what you just mentioned, right? You know, even when we have these periods of time where we're sitting at all-time highs in the market, it doesn't mean just like blindly go do something. You know, that's not what we're looking for. We still want to be thoughtful about it and make sure that we have some sort of intentionality or some sort of a plan, even when we're putting those money or deploying those dollars. And really that dollar cost averaging, it's an emotional management strategy. That's really what it is more than anything else. Just a little bit of money over a period of time, putting it into the market over consistently, and that's what actually causes a lot of success. The best dollar cost averaging strategy that I think that we see, most people do it inadvertently, 401k plans.
Yep.
401k contributions happening every single paycheck, just chucking a little bit over on there, and over time it continues to build and snowball and creates a really, really good situation for the people who are participating in those plans.
Well, I can also tell you, because we work with a number, quite a few, what we consider high net worth clients. People think, the general population thinks that people with high net worths and higher incomes invest differently. I can't tell you how many people that have very high incomes they don't just write big checks. Like people think, oh, they write $1 million check to go invest. That's not how they do it. They dollar cost average it. I have clients who are putting in $2,000, $5,000 a week because they're buying every single week. They're dollar cost averaging. It levels out the road. So yeah, the person making $1 million, they're investing $250,000 a year. They're not writing a check. They're doing it just like their 401k. They're doing $5,000 a week or
Right.
$2,000 a week. And I'm putting this money in on a very regular basis and making buys. And part of the reason I think dollar cost averaging works, especially in the case that you just mentioned, Casey, the 401k. I actually had a client who's in here, new customer. Her goal was to have her personal 401k hit $1 million. And it was like 830,000. She came in here, I don't know, 2 months ago. Now it's at 905,000, whatever. And she goes, I never thought this account would grow if I wasn't putting any money into it. And we started having the discussion. She's been maxing her 401k out for like 20 years. I said, well, when you had $200,000 in there and you put in 20 grand, it went up to 220 and you made 8% in growth. It just did another like 10 grand, 16. You weren't at critical mass. There's no critical mass in the first 100,000 where it's exciting.
Right.
I said, now you're to the point when the market goes up 10 and 15%, you get like some meaningful gains in the account. And she's an all equity investor. She's retired, but she wants all equity. I said, you'll get meaningful gains doing that. But dollar cost averaging is boring. But here's why I think it works in the 401k smaller balances. People don't see the dips. If you have 200,000, the market goes down 10%, went down 20 grand. Well, if you put 20 grand in, it stayed about even. You're like, oh, it wasn't so bad. I didn't make any money this year. You don't see the negative dip. Or when you have an account that you put one lump sum into, you do a rollover, you write a check, it's up and down. You don't have any contributions to make it feel better, even though the performance is exactly the same.
We've been talking about 401ks as far as the way the market's ups and downs go. And when you said, if you have $100,000 and it drops 10%, that's one thing. And I started thinking, if you got $750,000, you hit a 10% dip, you just went down to $675,000. And that just feels like the bottom just dropped out because you dropped from a milestone all the way down. That's just in 401k.
Right, but keep in mind what you just said, right? And this is something that you said a little bit earlier too. It feels that way.
Right.
And so when we look at that feeling or that emotional anticipation, it hurts a lot more in that particular context, right? And so especially when we take a look at a lot of these different strategies, it's don't misunderstand me, the investment piece of it is incredibly important, but the emotional management aspect of it is as important, if not more so.
Do you find yourself working with clients on that? The more money that they accumulate, the more that they invest, and the more that they've accumulated, is that management process of the emotions and the feelings? Because I know, if you've played poker or played craps or blackjack, you start racking up some chips, and pretty soon you get pretty heady. You can feel your heartbeat in your ears, and you're getting red.
I think it's relative to your economic standing.
Okay.
Like when people get to 500, that's the most money they ever had, right? So when they see it go down 50, they're like, oh man. When you hit 2, 3, 4, 5 million, number one, the person that has accumulated that probably made a pretty good income.
Yeah.
And if they put together any type of a financial plan, and say they got $4 million.
Yeah.
The thing goes down $800,000. Well, what they recognize, I still have 3.2 million. It's not really the end of the world. And if I have a distribution strategy, I can plan on it. I think you've said it a lot, Jonas. People that have less than 500,000 saved are the ones that are most emotionally affected by market dips. Because they see that number. If you have 500,000, you're 65, and you see your account go down $150,000, there's the fear of running out.
Yeah.
If you have 5 million and you see it go down 1.5 million, it's still 3.5 million. You're not fearful you're going to run out. You're fearful that you might have to adjust your lifestyle for a small period of time, but you're not going to run out of money.
What we try to do, Doug, if they have a lot of chips, on the table, and Americans are having a lot of chips on the table now. You look at the, we had 400,000 401k millionaires back in 2023.
Okay.
Now we have 600,000 401k millionaires. some of those folks were janitors. I had one customer that her last 5 years at the factory, she was cleaning the bathrooms, and she was doing it well, and she was a 401k millionaire.
Right.
I had another customer, and what we try to do is kind of recalibrate. If they get a little bit nervous, what I try to ask them is, walk me through the backstory on how you save this money. And it just kind of maybe a rush of praise for themselves. They're like, oh, well, I had one customer say, well, I just drove used cars to the point to where they were so junky I couldn't even trade them in. They were just at the side of the road. I had the whatever you call it,
scrap metal guy
scrap metal company come and take it.
That.
And my best friend bought Corvettes, and I maxed out my 401k. He didn't, and that's okay for him, but it's better for me.
Right.
And so you kind of walk through the backstory, and I think that Roger's right. If you get to the point where, what did you call that, mass?
Critical mass.
Critical mass, where you're used to the adjustments, you're used to the fluctuation at the higher balances. What floors me is, I'll have a customer that wants to go on vacation, but they don't want to spend the $5,000, and then I'll just have to settle them down and say, do you understand that your balances are going up $5,000, either up $5,000 or down $5,000? While we're talking here today about this vacation, go take that vacation. And
if you got $1 million, your account's fluctuating probably on average somewhere between $3,000 and $6,000 a day.
Absolutely.
Like 1% moves aren't totally normal. But
They're not
a quarter
atypical
to
either.
Yeah, but a quarter to 0.75% up and down, like I don't know what it's doing today. It's probably up 40.4%, and like goes back and forth. But you're right, Jonas. Most people's accounts are fluctuating that on a daily basis that are retired.
Yeah.
Well, and to go back to something you asked, Doug, as far as like the psychological impact on that, I think it very much depends on when somebody actually came into the dollars too. Right? Somebody who's been saving over a very long period of time and they've had some time to see these things fluctuating, they've got experience with it.
Right.
That is a different conversation emotionally for somebody who received it through an inheritance.
Oh, that's a really good point.
That's a
So,
great point.
somebody
The
who had
temperament.
like a large, it's just somebody who's never seen that suddenly has this large influx of cash and doesn't know what they're doing.
Yeah,
There's a lot more, I'm going to call it hand holding,
Yeah.
that happens over in a situation like that compared to somebody who has really built things over a much longer period of time as well.
And
That's
it's
a really good
critical.
point, because you give a 30-year-old $2 million and they've never been through it, it's not going to be good, because they're likely all equity. They're probably like, hey, I need to be all equity, and they see $2 million are down $600,000 in a similar to a 2022 market where the market's down 25+%. They're going, whoa,
Yeah.
Right.
500 or 600. How am I going to get it back? And they haven't. To your point, they haven't been through the cycles to see how it works.
It's so funny, real quick, planning for people that have gotten a windfall is 10 times tougher than planning for somebody that has a 401k. And it's the same amount, Doug. It's the same amount of money, but the planning's more difficult for the financial advisor.
It's similar to, you get an individual who goes to the NBA, signs a $30 million contract. They might be 24 years old, but you almost have to treat that individual like they are retired, because, if you have an NBA contract, I don't know what the life expectancy of an NBA player is. It's probably 3 to 5 years. So you get one big contract, you make $30 million. There's no guarantee you're going to make money anymore. So you actually have to treat it a little different, just like the person with the inheritance. They might be 30, but you have to treat the money a little differently. You almost have to say, hey, this is as if you're retired on this money now.
So
Make
if
sure it
there's
lasts.
any NBA players listening to this podcast, just keep that in mind.
or
And,
any of those.
Doug will say the 800 number here
And we
again,
do not offer NIL money. There are no sponsorship opportunities. Maybe for the right
That's
guy.
great. Would it be hilarious if we just pop up and we look like the professional fisherman like Spike used to be, that just stuff it all over yourself? You're listening and watching the Premier Investments and Wealth Management Financial Program. Doug Wagner along with Roger Abel, Jonas Everett, and Casey Mushrush. Get in touch with them today. It's important that you do this for your financial future because odds are you don't know if you're ready for retirement. But there's one way to find out at premieriwm.com. Just answer a few questions after you click Get Started, and they'll provide you with a one-page Premier Vision document and an appointment to sit down with them to talk about your financial future. They'll explain all this stuff that we're talking about in the level of detail that you want. Some people want the detail, and they want that one-page Premier Vision document that they can look at and scan everything right there. Some people want the 150 pages behind it, like this guy over here, and he'll explain all the way through with you on how that whole thing works. PremierIWM.com. Make your appointment today with Premier Investments in Wealth Management, named to Forbes 2025 Best in State Wealth Management Teams. Going to wrap up here over the next 10 or so minutes. We're going to talk a little bit about some of the most important things you talked about. We've talked about lows. We've talked about highs. We've talked about people who are very amateur or passive investors. We talk about people who are active investors. But there's some key points that are relevant at any and every single time. Let's take a couple minutes on each one of these. You talk about focusing on your long-term goals. Number one, you don't have that unless you have a financial plan.
And here's what a financial plan does because there's two types of investors. You have accumulators and decumulators, those who need income from their investments, those who are building. If you're in the accumulation stage, the number one most important thing to get in your financial plan, get your savings rate right. That's all you have to do. It's not that much harder than figuring out what is my savings rate that gets me to accomplish my goals at 55 or 60 or 65. If you can get your savings rate right, you can start dollar cost averaging into good investments. It will work. And like I mentioned earlier, high income people are doing exactly the same way.
Yeah.
I don't want people who are making 200,000 to think that the person making 2 million does it differently. No, they don't. They might dollar cost average more every month or every week, but they're doing the same thing. The principles are exactly the same. Because if they don't dollar cost average, you know what happens? The money sits in their bank account and it will get spent on something else. Doesn't matter how much money you have. If it doesn't have a purpose, it's going to go away.
Yeah. By the way, one thing you do is check with your financial and wealth advisor because you may have some catch-up contributions if you are available for them that you can use some of that money for if you do have money sitting around and just sitting in the bank account. So that's another important part of having a financial plan. Jonas, one of the things that you talk about, and you said this many, many years ago, and you must be a farm boy at heart because you were talking about the needle versus the haystack and diversifying.
Absolutely. You know, I think that every time I buy an individual stock, it goes straight down. So I have to wonder if anybody has better luck at that. But kind of like Casey talked about, you know, all these investments that we usually look at are prepackaged investments, and they're very, very diversified. So yeah, and you know that if you look at owning a haystack, you're not going to hit any home runs. You're not going to double your money every year. But you look at the data that Roger has, Doug. If I had an investment for you that your money doubled every 7 years, how does that sound?
I'm very happy with that.
I would be very happy with that too.
And I will continually invest in that.
Yeah,
so just a pretty average haystack.
Yeah, absolutely.
It's nothing special.
No. That's good. And it's the kind of common sense that you get at Premier Investments in Wealth Management. The other thing, Casey Mushrush, is the idea of you don't want to visit it every single day, right? It's kind of like, you know, I remember years ago when my mom was still alive, talking to her every single day was kind of difficult because you get in that same sort of pattern. So maybe make it once a week. If you're going to visit your portfolio's balance, maybe visit it less often than you think you should. But it's important to have somebody like you as a wealth advisor, maybe a reminder to press that automatic rebalance button. What's the importance of rebalancing?
Yeah, the rebalancing. I mean, if you really look at what it's doing is we're trying to smooth out the peaks and valleys. You know, over time, we have different asset classes. To Jonas's point, if we've got a well-diversified portfolio, they're going to do different things. And really that rebalance is simply realigning that according to what our original allocation was that we developed underneath that financial plan. So it's just making sure that we stay on what that developed target was. You know, and periodically is the way that we explain that to people. And they say, well, how often is periodically? Well, not every day,
Yeah.
but probably a minimum of at least once a year. And then maybe somewhere a little bit more over within that as well.
Well, typically the beauty of rebalancing is it's rules-based, meaning we're going to rebalance 2 times a year, or if one investment drifts and becomes too much or too little of the portfolio based upon market performance, that could trigger a rebalance. So if you had one asset that went up 30%, that could trigger a rebalance, but rebalancing is rules-based. And most people can do this in their 401k. Like they can go hit the button that says automatic rebalance 1 time a year, 2 times, 3 times, 4, whatever. It's rules-based.
Well, and one of the other things it does, and I know we were kind of hating on the whole buy low, sell high idea.
But that's what it does.
But that's what it does.
But
it
no,
forces you over into that
here's the difference.
discipline.
It doesn't tell you to buy low. It's telling you to buy relatively low.
Correct.
It could be higher than it was before. So think about it. If you have two investments in the stock market, one's technology and one's a stock market. The stock market went up 20 and the technology went up 40. Well, we're going to sell technology, buy more stock market, but stock market's still 20% higher. So it wasn't lower. It was relatively lower.
Yep.
And I think that's what people miss. They think they should buy a lower price.
Right.
Relatively lower.
Let's stick over there with you because you brought up something a little bit earlier as far as talking about the accumulation and decumulation, or the distribution part, is that you need to know just exactly where you are to determine what you need as far as the money and what bucket and its availability. And that's something, if you get that wrong as somebody who's not a professional, you can really screw up a lot of things in your life, including taxes, including, well, the investments that you have. Talk to me about the importance of understanding your liquidity needs as you go through life.
Once you're within the distribution phase, it's arguably the most important component. Like having enough risk to get the growth you need is one thing, but if you don't have your distribution strategy on point, this can blow it all up. And we've run scenarios and we have a little case study called Mr. Smith and Mrs. Jones, but it's 2 investors who have the same asset allocation, the same withdrawal rate, but what they don't have is a real distribution strategy. They just say, hey, we're going to take money from our portfolio. One person runs out of money in 10 years, the other doubles their money. They did exactly the same thing. And it's just getting unlucky with the sequence of returns and making sure that you have enough liquidity, or what we call our bucket strategy. Doesn't ensure that you're not going to run out of money, but it makes it a whole heck of a lot more probable that you won't have to sell a stock market investment when it's lost money. And that's how you ultimately kill your portfolio. When you have to sell something at a loss to raise money to live on.
Yeah, it's the forced liquidation.
Yeah. So we want to, that's a really good analogy. Eliminate forced liquidation, which is just having a strategy put in place for distributions.
You know, it's interesting because, Casey, I'm going to go to you and then I'm going to finish up with Jonas over there. This idea of, you talk about forced liquidation. There's a lot of force on us in a lot of places, and we've talked about this the entire time, is evening things out. And the heart of this, dollar cost averaging, if everything tends to the middle, people tend to try to push back, but it's really tough to push back against the markets, the animal spirits, and Mother Nature.
Yeah, I mean, the gradual investing, the dollar cost averaging, doing a little bit over a long period of time. I mean, these are the things that really do, again, from a behavioral standpoint, allow people to really succeed. And, you know, at the end of the day, whether you have the best portfolio or maybe one that's not necessarily quite the best, if you will, consistency over time, those kind of principles are really what are going to drive success over to the future. And those are really what we want to focus on, you know, more so than anything else. Now, I do want to point out, too, we do have a guide actually as well, this investing during market highs, and you can go to premieriwm.com and actually download that guide in order to see a lot of the information that we were talking about today. You can also see some of the charts I know that we kind of reference back over that's built into that thing. But that is a great place to go through and take a look at how do you develop and how do you design your portfolio when we have these all-time highs that we keep hearing about in headlines.
This is what's really neat about our radio show. We're constantly learning too. Because until we put this together, if you would have said what has a better 1, 3, and 5 year return, buying a dip or buying an all-time high, The vast majority of people will tell you it's buying a
Buying the
dip,
dip.
but it's
Absolutely.
not. It's buying the high
Yeah.
because we have a new one every single 19 days.
Yeah, that's amazing. You know what? I think that, Jonas, finishing with you, the concept of working with a financial professional, because you know what? You and I have got to the point where you say, I'm going to hire a travel agent because I need them to handle all the issues if something goes wrong. So it's almost a form of insurance, if you will. You've got somebody, a wealth advisor, who has the wherewithal, because they do this all the time. That's what your job is.
Well, we're really, I think maybe an 8-headed monster now. We're really interested in this stuff. And I told you the story. I went to my dermatologist, and he looked at my skin for maybe, I'm going to say it was less than 3 minutes.
Yeah.
And he said, you have 2 pre-cancer spots. You can use the lotion and look like a skinwalker or Sith from Star Wars for 3 weeks. Or I have this big tank of liquid nitrogen, and we can get rid of those. And I thought to myself, man, if I was trying to, do this myself, I would be in some serious trouble, because he located the spots just right away. It just kind of, I was flabbergasted by
They're
that.
professionals. That's what they do for a living. And these folks are professionals too at Premier Investments and Wealth Management. Named to Forbes Best In-State Wealth Management Teams for 2025, Premier Investments and Wealth Management at premieriwm.com. Click Get Started and answer a few questions. They'll provide the one-page Premier Vision document. Or if you just can't wait now, pick up the phone. Number is 800-383-6590. For Roger Abel, Jonas Everett, and Casey Mushrush, I'm Doug Wagner. We'll talk to you again soon.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments in Wealth Management and LPL Financial do not provide specific individualized tax or legal advice. We suggest that you discuss your specific situation with a qualified tax or legal advisor. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. Dollar cost averaging involves continuous investment in securities, regardless of fluctuations in price levels. Investors should consider their ability to continue purchasing through periods of low price levels. Such a plan does not assure a profit and does not protect against loss in declining markets. Forbes Best in State Wealth Management Teams ranking was developed by Shook Research and is based on in-person, virtual, and telephone due diligence meetings, and a ranking algorithm that includes a measure of each team's best practices, client retention, industry experience, review of compliance records, firm nominations, and quantitative criteria, including assets under management and revenue generated for their firms. Investment performance is not a criterion because client objectives and risk tolerances vary, and advisors rarely have audited performance reports. Shook's research and rankings provide opinions intended to help investors choose the right financial advisor and team, and are not indicative of future performance or representative of any one client's experience. Past performance is not an indication of future results. Neither Forbes nor Shook Research receive compensation in exchange for placement on the ranking. For more information, please see www.shookresearch.com. Shook is a registered trademark of Shook Research.